Stories now with Stephen Carroll. Hi, Stephen.
Hello, Catherine.
We just mentioned it there. We're talking about events in China, the People's National Congress getting underway, and the economy, quite a big issue.
Yeah, the Chinese government uses the People's National Congress, this parliamentary session, to outline some of its economic goals. One of them is the planned growth rate for this year. What the Chinese government has said is that they want a growth rate of about 7.5%. That's the same as what they told us last year. So they're continuing on the same sort of policies. But let's just look at how that compares to China's actual growth rate in recent years. You can see that it was up, in fact, over nearly 10% back in 2010. It was, in fact, up over 20%, over 10%, excuse me. It came back down to 7.7%. There at the last figures that we have for China. So that is the lowest rate it's seen since 1999, in fact. And the same rate that was given in 2012. Now, the most recent economic surveys have actually shown the Chinese economy is facing a sort of a downturn again in the first quarter of this year. It'll be waiting to see whether the Chinese government will have to intervene to stimulate the economy further to keep it at around that target rate of 7.5%. That's a key figure coming out from Beijing today.
Of course, a fallback for Beijing, but that's a growth rate other countries could only dream of right now, isn't it? Well, how are the markets reacting to that economic news?
Well, shares in Shanghai actually down on that news, just slightly touching into the red in the most recent figures. You can see it's down just about 0.2% there. Over in Hong Kong, the Hang Seng, though, in slightly better shape there. They're also dealing with the first day of trading for Fast Retailing, the Japanese clothing group that owns Uniqlo. Their shares listed on the Hong Kong Stock Exchange from today opened up about 4%. The biggest gain seen, though, on the Nikkei in Japan. Relief there as the threat of Russian military intervention in Ukraine seems to be receding for the moment. Take a quick look at how things are looking on Wall Street as well, how they finished up last night. The general relief over the situation in Ukraine helping all of the markets into big gains, as you can see the S&P 500 hitting a new record in trading on Tuesday.
Okay, so relief for investors on the stock markets, but the threat of economic sanctions hasn't entirely gone away. Economic sanctions on Russia, I should say. Tell us the latest about where we stand with those.
Yeah, I mean, John Kerry had originally spoken about this idea of visa bans for Russian officials and asset freezes. We're now told as well that sanctions on Russian banks are being discussed too in Washington. They would be Iran-style measures, a similar measures we've seen imposed on Iranian lenders to try to cut them off from the US financial system. Of course, a key part of the global financial network. Of course, as with all of these sanction discussions, there's less enthusiasm for them here in Europe, and there could be resistance to imposing any of those measures.
Okay, and there's some quite worrying news for Ukraine, as Russia says that they're going to end their discount on gas.
Yeah, this will be a really big effect on the Iranian economy. In December, the Russian president announced that Ukraine would get a discounted price on its gas supplies as part of a $20 billion aid package that brought the price of 1,000 cubic meters of gas, a standard unit, to just under $280. That price is due to be reviewed every 3 months. Gazprom saying on Tuesday it will go back up to about $400 from April. The company says that Ukraine owes it more than $1.5 billion for unpaid gas bills. Let's listen to what their CEO had to say about that debt.
Under these circumstances, in which Ukraine doesn't honour its obligations and doesn't meet the conditions agreed when an amendment on the discount was signed, Gazprom has taken the decision not to extend the discount period from the beginning of next month.
Okay, let's move on then from those international political concerns to Geneva, where the motor show is getting underway this week.
Yeah, things finally looking a little bit more optimistic for those European car makers after years in the doldrums. The industry is expecting a 2% increase in sales this year. This after a 6-year slump, with sales hitting their lowest level since 1995 last year. But as Joe Tandy now explains, there are warnings that the crisis in Ukraine could put a halt to that turnaround.
The show's on the road. In Geneva, car bosses say that after years stuck in first gear, the auto market is at last beginning to pick up speed.
In most markets, there's a sign for more demand than we had in the prior year, and we take it step by step. I think the important piece is that mentally we say goodbye to the crisis years.
This year, small cars grab a larger than usual share of the limelight, with France's Renault showing off a more compact version of its popular Twingo. Meanwhile, many car makers are tapping into smartphone technology. Ferrari, Mercedes-Benz and Volvo unveiled models carrying Apple's multimedia service CarPlay, while Volkswagen plugs into Google's Android technology. In 2014, experts say digital technology will increasingly be in the driving seat.
You're going to see much more innovation with high-tech features such as applications for iPhones, Android, and all that type of stuff, where you're going to see much more computerized features that people are going to want. You're going to see cars starting to drive by themselves, autonomous cars. Google is working on that.
Among dangers on the horizon, fallout from the crisis in Ukraine. Car bosses say tensions between Kiev and Moscow could yet force another slowdown on the European car industry.
There's not a single doubt in my mind that if the situation in Russia and Ukraine remains as tight as it is, or if it worsens from where we are, that it will dampen demand in Western Europe.
Russia and Ukraine are crucial to the fortunes of several major car brands. Ford, Renault and Toyota could all pay a high price were Moscow and Kiev to collide.
Very snazzy stuff indeed. Thanks very much, Stephen Carroll, with all the business news back in 1 hour's time. With more, we're going to check out all the stories making waves on the internet.